Well, welcome everybody. Thank you for joining us on our Future of Funding series. Today we have Etan Butler of Dalmore Group, and we have a great discussion for you. Just want to remind everybody throughout the duration, if you would like to ask a question, please drop it in the chat box, and Hall will be fielding those during the session. And with that, Hall, do you want to take it away?
Great. Thanks, Shane. And Aiden, thank you for joining us today. Appreciate your coming out to tell us more about what you're doing with the Reg A and CF world with the Dalmore Group. And can you give us more information about yourself and your firm? I don't know if everybody's heard of you, but it sounds like you're doing some cool things.
Thanks, Hall, and thanks for having me today. So I'm Etan Butler. I'm the chairman at Dalmore Group. We are a FINRA and SEC registered broker-dealer investment bank headquartered in New York. We were founded in 2005 and spent the first 10 years or so focused primarily on providing institutional investment banking and corporate advisory services. And since the Jobs Act of 2012, we've made a shift to helping companies raise capital primarily online at scale through regulations D, A, and CF. I think today what we're most well known for is our involvement in Reg A. We currently have over 210 Regulation A clients. We've been fortunate to be the broker-dealer on a number of the more successful Reg As that have been done to date.
Great. For those who are new in the audience, can you describe the differences between Reg CF, Reg A, and Reg D?
Sure. So Regulation CF is an exemption, a securities exemption that allows for companies to raise up to $5 million per year from pretty much anyone over the age of 18. Regulation A is an exemption that allows for companies to raise up to $75 million per year, also from pretty much anyone over 18. Regulation D is an exemption that allows for companies to raise an unlimited amount, but they could only raise capital from accredited investors, roughly 10% of the population that meets certain minimum income or net worth requirements.
Great. And when somebody comes to you and they ask which is the right way to go for them, A, CF, or D, how do you coach them on making that decision?
It has to do with how much capital they're looking to raise. And it also has to do with their existing ecosystem of investors, if they have any. So for example, if a company is looking to raise $5 million and they already have an existing ecosystem of either investors or a network of followers or associates that they want to kind of target with that opportunity, and they're not necessarily going to be reliant on broadly marketing or advertising the offering, you may want to consider a Reg D. It is cheaper to set up, it's quicker to go live. Again, you're limited to accredited investors, but if you have them somewhat circled, then it's perhaps a more efficient process to achieving that. If you're looking to raise up to $5 million and you intend to do so through effectively marketing and promoting your offering, you might consider a Regulation CF. Regulation CF is generally more cost effective to set up than a Reg A. Where a Regulation A offering requires SEC qualification. So it's a process where you're hiring an attorney, you're going through a qualification process. It will take you a number of months, 4 or 5 months or even longer for making that decision before you go live. Whereas a Regulation CF is something that you could get up and running in a number of weeks. It doesn't require SEC qualification. It's a notice filing with the SEC before you go live. So up to $5 million, I would say, and you want to broadly market and you want to be able to raise capital from anyone over 18, Regulation CF is probably a good choice. And if you're looking to raise beyond 5 million and you want to market and promote your offering, you may consider a Regulation A.
What type of companies do you see taking on Reg A and being successful with it? Any examples or case studies of the type of companies that they should consider a Reg A because that's a good fit for them?
So I think it spans the spectrum. I mean, we have companies as basic as kind of real estate issuers, all the way to exotic companies in the, let's say, cannabis or blockchain or even psychedelic space. So and everything in between. To succeed with a crowdfunding, right, a Regulation A or a Regulation CF offering, where you're broadly marketing the offering, the success is going to be tied to how effective your marketing and promotional efforts are. And I think that could apply to really all companies. It may be easier for companies that are in industries that are more relevant to a broader swath of the population, both in the U.S. and abroad. Whereas a business-to-business entity in mid-America that's looking to, raise capital for a tractor part, it may be more challenging to find enough investors that will understand that, appreciate it, want to be a part of it. So you see consumer brands, you see cannabis, you see medical, you see real estate, you see things that more people that resonate to a larger audience, generally that have a more effective marketing campaigns.
And how long does it take to prepare a Reg A, for example, and then how long does it take to prepare a Reg CF with the compliance and the other work to make a successful campaign?
Well, it'll take you somewhere between 4 to 6 months plus to make a decision to launch a Reg A before you're actually live with a landing page and an Invest Now button. Whereas a Regulation CF, it could happen within 6 weeks, depending on how long it takes you to get your audit, right? That's always, but generally within 6 weeks to get through the diligence process and to build the landing page and make the integrations to go live.
So we have a question from the audience. What are the limits on the number of people who can participate as investors in each pathway, say an A+, say a CF, or say a 506C?
We've had some Reg A's with over 10,000 investors. My compliance team would be better suited to give the specific numbers, but I know that a number of our offerings have been well over 10,000 investors.
So I believe Reg D had a limitation of some number of investors, at which point you have to close it and then do something else. So it seems like that's a plus for the Reg A and CF, that there's really no limit as to how many people can come in. So my next question is, one of the things that most people believe is that when you run a crowdfunding campaign, Reg CF, you have to be on a crowdfunding portal that's out there. And I understand from your group that you can actually run these campaigns on your own website. And you mentioned an Invest Now button. So, for consumer product goods companies who want to get brand name recognition and take maybe some of the attendees to the website to turn them into customers, they can actually run the campaign on their website. Can you explain how that works?
Sure. So to launch a Reg CF campaign, you need to do so through a registered CF portal or a registered broker-dealer, right? So we have an interesting model, and how the industry typically works is, at least amongst the CF portals, is they list. It's kind of like a marketplace where they list you amongst many other, sometimes competing offerings on one portal. Our model is very unique in that we create a separate landing page, a separate offering page. So if you're Acme company, we might create a domain called Invest in Acme Co, right? So we, as the broker-dealer, are hosting and controlling that page because it's part of our broker-dealer, right, for CF, but it gives the issuer the opportunity to kind of design the page themselves, to brand it, where we look somewhat behind the scenes in our role, and the issuer really shines, right? We obviously have to approve all the content, all the marketing and promotional materials. We have to make sure the appropriate disclaimers and disclosures are there. So it's not just putting a Invest Now button on your own website. It's really our website, right? But it's branded according to the issuer's needs.
Great. And then how long do most of these campaigns run for Reg A? If you're raising $50 or plus million, it seems like it could take some time. What's the average time for Reg A running out there?
It varies. It depends on how effective your marketing and promotional efforts are. It depends on whether or not you have an existing ecosystem of fans, followers, subscribers, users, investors to leverage, right? That might participate. And it depends on whether or not you have, syndication or selling group participants that might be able to be effective, or co-listing opportunities amongst other platforms, or if you get featured in a financial publication or a newsletter. These are all ways to get your message, your opportunity out in front of a wider audience. Whereas if you're solely reliant on digital marketing alone, it could oftentimes be a bumpy road to build up sufficient, return on advertising spend and conversion. So an extreme example is one of our clients, Gage Cannabis, raised $50 million in a CF in under 3 months. Now, don't expect that, issuers out there. That was because they had a big institutional investor that participated, and I think that broadcasted a lot to the retail community that soon after followed to fill the offering up. Whereas we have some companies, some issuers who struggle, right? They don't have a sufficient marketing budget. They don't have an existing ecosystem to go after. This is not a you build it and they will come type of a model. This is you build it and you effectively market and promote a compelling opportunity to investors. Now, as far as, so we have some issuers where the duration of the offering might be 3 months like Gage, and we have some that go the full 12 months, right? And don't hit their maximum allowable amount, right? And they may continue the following year. So it could be ongoing. The other component I'll mention is that it really depends on the strategy. For a typical Reg A offering, the issuer is, in essence, offering shares or issuing yield from their company, up to 75 million a year. There are other strategies that utilize Regulation A. We call them fractional share series issuers. These are companies that get qualified for the same maximum $75 million a year, but they're not issuing shares of their company. They're creating individual assets, each in their own dedicated corporate structure, that are collectively, in essence, drawing down from that $75 million amount, but they're releasing things like a Michael Jordan rookie for $100,000, or a single family home, or a racehorse, or an athlete contract, or an NFT. Right? So we have about 25 of these platforms, and these are perpetual, ongoing offerings. Right? They build a community that's looking to participate by building a portfolio of these individual assets over time, and we also help them facilitate the secondary market trading of those securities. Right? So these are ongoing offerings, whereas a typical Reg A might be a once and done type of an event.
I remember there was a rule that said if you had more than a certain number of investors, you were automatically a public company. How does that play into a Reg A raise, or do you consider Reg A basically you're a public company if you raise a Reg A?
Well, it's not you're not a public company. Although we have Reg A clients who are public companies that utilize Reg A, right? So you could be a private or a public company. It's a tool that allows for companies, private or public, to take unique share class structures to the public, right? So it is a public offering in a way, but you're not necessarily a public company.
But does that, you get a large number of investors with a Reg A, so does that trigger the rule that turns you into a public company? And so what is that rate?
I would ask my compliance and in-house legal for those specific numbers.
So what would you have as advice to those who are considering a Reg A? What do you tell them to do before they go down that path?
Set yourself up to win. First, make sure you build a stable ship. I consider a stable ship having experienced counsel and an experienced broker dealer. So so from a structure and from a compliance and regulatory perspective, you want to make sure you're positioned very well. Then it all becomes about how do you build an extra advantage going into the offering, right? Like I mentioned before, if you are solely reliant on digital marketing, my personal experiences, and we've worked with, I think, every company that wants to be known in the crowdfunding marketing space by this point, maybe not a few, but a lot of them. We've seen some fail, we've seen some win, and it's not the most predictable thing. Some campaigns struggle to build an adequate return on advertising spend through digital marketing alone, whereas others figure it out and they get the conversion metrics down that makes sense for them. And then they allocate more of a budget to continue that, right? They see a sufficient return on advertising spend in certain strategies. That's a great place to be, but not everyone's there. So you want to align yourself with other advantages to start, and these include, PR, right? PR is a very important and effective way to get your message out in front of a lot of folks. There are influencer networks. There are a number of our issuers that have celebrity partners. And in those cases, you get to leverage the influencer or the celebrities network. Again, more eyeballs that will have an interest in checking out your offering page and hopefully clicking invest now and signing a subscription agreement. And there's also co-listing and syndication opportunities made available that you could do with the Regulation A offering. So with our model, you could have an invest now button on your website for a Reg A, right? And your job is to steer as many of your own ecosystem institutions and marketing and PR to your own website, and for a pretty low cost structure relative to what marketplaces charge. But you don't have to stop there. You could also build a syndicate and you could co-list your offering on other marketplace platforms, right? You have to pay their success fee, but they're 7 and 2 or whatever it might be, but they deserve it because they're delivering investors from their platform to you. But for the investors that you're bringing to the table, our belief is that the transactional cost should be low. And more importantly, you should be the sole beneficiary of your own marketing and promotional efforts. And when with our process, someone clicks on learn more when they see an article about you or an ad pop up, you're the only game in town. You're led to your offering page. You have full control over the analytics and the page tagging and the pixels that you could insert. So your marketing company could track the effectiveness of the marketing and promotional efforts that you're really responsible for.
Great. So we had a question from the audience, and it applied to what you said a moment ago. Did we just hear that you're building a platform to sell a collection of NFTs via Reg A+, and the ownership of the NFT is in the holding company, not in the individual? Is that correct?
The ownership of the asset that I was referring to is within the dedicated corporate structure, or LLC, surrounding that specific asset, right? So if you go to our website, dalmorefg.com, there's a tab called Fractional Share Issuers. And there's probably about 20 of them, of our clients listed. And you could check out their site if you'd like. This is not a recommendation to purchase securities, of course. But since you asked, it's they're called series issuers. So you set up a series LLC rather than a regular LLC or corporation. And that allows for you to release individual assets one after another. So your investors could choose to participate in this single family home, but not that. They could build a portfolio of single family homes, or of watches, or wine, or racehorses, or NFTs. And then oftentimes these fractional share issuer platforms have an interest in activating secondary market trading. One of the other big benefits of Regulation A, unlike Regulation D and CF, which have a 1-year hold period of the shares before you could facilitate secondary market trading of those securities, Regulation A does not have a seasoning period of the shares. So there's an immediate path to potential liquidity, provided there's someone on the bid. And so a lot of these platforms facilitate the IPO of an ongoing number of these assets, and also facilitate the secondary market trading of those assets.
Great. So a moment ago, you said set yourself up for success. And so the question from the audience is what type of infrastructure or cost is needed to effectively execute a Reg CF or Reg A? For example, is an in-house marketing team needed? And is the cost of a Reg CF or Reg A an approximate cost of the raise?
So you don't need an in-house marketing team, but if you don't have one, you may consider hiring a marketing consultant, right? Like an advisor. And there's a number of them out there that specialize in helping companies raise, market and raise capital online at scale. We work with many of them. We've seen, who has performed, who hasn't, and we try to, and we're always getting smarter on the marketing side, and we always look to share that knowledge and experience with issuers. But for both Reg CF and Reg A, there's an upfront cost component, right? You need an audited financials. For Reg CF, if you're looking to raise over $1.07 million a year, over 1.07, you need audited financials. And for a Reg A, you need audited financials, 2 years audits. I mean, if you're a newco, you need to audit the newco, but if you've been around for 2 years, you need 2 years audited financials. For a Reg A, you need to hire a securities counsel, right? And that's expensive. They're drafting and structuring a very large document, the offering circular, which is called the Form 1A, which gets submitted to the SEC for qualification. That could range from $50,000 to $100,000 plus. in legal fees, right? Then oftentimes the broker dealer will have an upfront fee for due diligence and onboarding. So between accounting and due diligence and onboarding and legal, your upfront expense, your burn for getting a Reg A up and running could end up being in the $100,000, $90,000 range in some cases, right? For a Reg CF, it's much more cost effective, at least the way we approach it, because you don't need to pay an attorney $50,000, $60,000 to get an offering qualified, right? You may have counsel and to help you structure, your offering, but there's not generally that large legal fee component. So the cost goes down significantly for a Reg CF. So lower cost, quicker time to market. And that's why I think since Reg CF was bumped up from 1.07 to 5 million max the previous March 15th, which is when we got active in it, you see more folks that are starting with the CF because it's cheaper. You could still raise money from anyone over 18, and 5 million is a real number. 1.07 wasn't for everyone, right? So you'll see folks do a CF and then with plans to follow up with a Reg A. Dalmore is very focused on Reg A. We have been for a number of years now. And again, we got interested and focused on Reg CF when it was bumped up to 5 million. We focused more on the issuers looking to raise between 3 and 5 million, not necessarily issuers looking to raise a few $100,000 or $1 million. We generally would refer them to one of the marketplace CF platforms for that purpose. So those are the approaches.
Right. The next question is, what about all the platforms that claim they have 1 million investors? In your experience, what percentage of those convert to any other offering on the platform? Some people say that 70% of the funds come from that. Is that true or false?
Well, that's a great question. And I think this industry is growing so quickly, and there's room for all different types of marketplaces and different strategies like the ones we deploy. Yes, you're going to see numbers like 1 million or 500,000 users. The question is, how many of those are active investors? And the real question is, what's the average raise breakup as far as investors that come from the platform versus investors that come from the issuer's advertising efforts? I could tell you what we hear, not necessarily what the data is on their side, because I don't have access to it, right? What we hear are issuers that might sign up on a marketplace platform and not necessarily get what they had hoped for simply by listing on a third-party marketplace platform. There are certainly benefits because there's the potential to get in front of a lot of people that are registered and are looking for investment opportunities there. But the ones we hear from are ones that didn't get or don't believe they'll get what they had hoped for simply by listing on that platform. And they recognize that they're the ones, and that's why, we're focused on the larger capital raise side, right? So to raise, 5 million on a CF or raise real money on a Reg A, it's going to be challenging if your strategy is to hope that things come to you from listing on a platform. I think that you'll pretty soon realize that the success of your raise is going to come down to how effective you market and promote. And if you're responsible for marketing and promoting the offering, why am I sending my investors to a third-party platform at that point is something we hear. We want to be the sole beneficiary of that. We want the transactional fee to be significantly more cost-effective to us. We don't want to be linked to other potential competitive offerings. Or companies that have a large base of customers, fans, followers, subscribers, users, they might not want their own potential investor base or existing investor base to get absorbed into another platform to be remarketed to with other offerings on a pretty consistent basis going forward, because they have future capital raising plans, right? And they feel that if we're converting our members of our own ecosystem into potential investors, we want a really clear, simple path to be able to do that. And by having your Invest Now button on your own website, that really presents a unique way and a clear way to convert ecosystem into potential investor.
Great. So we have 11 more questions here. This fractional ownership seems like a perfect way for a small holding company. Can you tell us something more about it?
You know, the best way to learn about it is probably to go to our website, because you'll see 20 platforms doing all kinds of things, from collectibles to racehorses to NFTs to watches to wine to dinosaur bones to Constitution to Buzz Aldrich's control stick from the space shuttle, to literally stuff that in the past a lot of people wish they could be able to own, but we don't have $1 million to go and buy a piece of art, right? So these things historically have transacted every few years at an auction, right? Today, anyone over 18 pretty much on a credit card, on an iPhone, could buy a share in a prized asset or in a single family home, right? They could get that fractional rental revenue directly to them, or they could have ownership interest in Michael Jordan's rookie, right? So that strategy is limited to the imagination of the issuer, whether it's a physical security asset or whether it's a digital security asset. Both can be fractionalized, both could go through the Reg A process where you could acquire them, you could build a community of folks that might have an interest in them, you could fractionalize them and IPO them, and then you could facilitate the secondary market trading of them. And that is fascinating. That's my favorite usage of the regulation, because you're building a community and this becomes part of your business model, as opposed to, I'm just looking to raise, $20 million and then I'm looking to go public. That's great too. And Reg A is a really great way to increase shareholders and increase capitalization at your terms and your structure, not a VC structure in terms, right? So it's also a great way to market your brand or your product at the same time as you're marketing your offering. So if you're a consumer products brand and you're considering, a capital raise, this is a really interesting way to make your consumers that much more loyal, right? That much more invested in what it is you're doing by becoming shareholders in that. And there's all kinds of studies about, once you're a shareholder, you're going to drive that X number of miles out of the way to go to the, what you own a $100 share in versus, so there's a lot of interesting advantages to that. But again, there's also the OTC companies that are launching Reg A's, to be able to market their stock and their structure. And so it really is a very interesting tool. And it's still very early days, right? There was only $1 billion in Reg A raised in 2019. Tiny. Wow. Compare that to Reg D in the trillions. And then in 2020, it went up to 1.7. 2021, the first 6 months was 1.6 or 1.7. So it's probably close to 3. So it's growing at that, pretty interesting rate. And more companies are learning about it and using it. There's 27 million private companies in the US. My guess is most of them don't know what Reg A, Reg CF means. It's like an alphabet, right? But they're more and more are learning about it, and more certainly reaching out to us.
Great. So the next question is, how does Dalmore companies manage any SPVs from a Reg A or Reg CF, or does Dalmore assist with any of that?
Dalmore doesn't manage or assist with SPVs. Securities Counsel does. So, for our Reg CF, we have a well-known a crowdfunding law firm that's part of our process that kind of oversees and is involved in our diligence and structuring. And so, they can be helpful as far as, what you can as far as set up with SPVs versus what you can't. And we include them in that process to provide those services to our issuers.
Okay. What are the estimated ongoing costs of reporting and audited financials for your company if you raise money with a Reg A or Reg CF? And what are the ongoing costs for annual compliance and filing with the SEC?
Dalmore doesn't have ongoing cost. For Reg A, you do need annual financials, put together. So I guess it would be based on how complex your books of records are, right? Like any audit. If it's a new co, it's a few thousand. If you're doing a lot of transactions and it's more complex, and it also depends on which auditor or accounting firm you're working with. But it's just, generally it's going to be a standard cost of an annual audit.
Great. Next one is, you're being very diplomatic. Tomorrow we're closing a $4 million raise, and 95+% of the capital we raised ourselves. Anecdotally, we brought more capital to the platform than they brought to us.
You know what? We're very close friends with the platforms, and our position isn't, our way makes sense, and the platform and to bash any platforms. Let's take the flip side. You work with us. You're an island on your own, right? You set up a CF or a Reg A. Okay, people have more comfort sometimes knowing at least there's a chance that this investor base is going to discover me, and I'm going to catch fire and momentum, and I'm on some platform. I don't have a big marketing budget. I'm looking to raise a few $100,000, and I want a chance. I have my friends. I have a little marketing strategy, but I'm nervous about existing on my own website, on the internet somewhere. And so, that's a fair way to look at it, and certainly if you're in that position, then maybe a marketplace is the best way to approach this, right? Whereas if you are looking to raise millions of dollars, and you go into this with the understanding, like whoever asked that question has learned, hopefully not the hard way, but has learned, you're going to realize pretty quickly that wherever you are, you're going to have to, there's no escaping. There's no magic bullet here where you sign up and money is going to be in your account. The issuer, the officers and directors, the CEO, you guys are responsible at the end of the day for making sure this thing succeeds. You want to align yourself with folks that are winning and that are doing this well and that have experience and that can counsel and guide you accordingly. But the ones that are counseling you and guiding you accordingly are ultimately going to tell you that this is going to come down to how effectively you market and promote this, right?
And so what is the general range of transactional fees across the different registration offerings, Reg CF, Reg A, Reg D?
So I could speak to for Reg A, my experience is on average, the marketplaces are charging somewhere between if you combine the cash and the equity, somewhere between 7.5% and 12.5%, right? Our Reg A fee goes as low as 1%. It's a staggering difference, right? And you get full analytics and control of your site. So your marketing company could determine the effectiveness of your own marketing and promotional efforts, right? Sometimes it's a bit opaque when your offering is on a third-party platform. For regulation CF, I would say it's the same on the marketplace side, that range I provided. Our regulation CF fee is 3 and 1, 3% cash fee, 1% equity fee. So it's designed to be around a third to a half of the cost, but also positioning the issuer as the sole beneficiary of their marketing and promotional efforts.
Hey, can you run a Reg D side by side with, say, a $5 million Reg CF?
Yes, you can. As long as it's disclosed, you are able to have a side-by-side Reg D, Reg CF. And in fact, they could be with different structure differently. They could be different terms, they could be different valuation. And that's done pretty frequently, right? Where you may have one approach is geared more towards VCs or institutional investors, and you might use your Reg D for that purpose. And your Reg CF or your Reg A may be a retail door into a structure of your company.
Great. Can we use crypto to raise capital instead of credit cards to keep the cost down?
You could use crypto, but you're not really using crypto. What you're doing is you're giving folks that have crypto the opportunity as part of the checkout process to buy the security, an ability to convert that crypto into USD to make that purchase, right? So you could use crypto, but it's really just converting the crypto first into the USD that's ultimately going to be making the investment.
What are the ingredients to a successful social media-based fundraising process, and which companies have really nailed it?
That's another great question. When you figure out, let me know. We're obsessed with it. I would say that the problem is with the amount of offerings we've done, we've seen everyone fail a few times, right? So there's no one that's out there that I've seen that says, we're always looking for the secret sauce for marketing because we want to help our issuers succeed, right? And we're tracking the data on the analytics, and we'll give you our advice on that. We'll tell you what we're seeing. But it's again, I'm going to get back to, if you're relying on digital marketing alone, my experience is be prepared for a bit of a bumpy road, especially in the beginning. There are issuers of ours that have cracked the code, or that have, figured out how to turn $1 investing on, let's say, Facebook into X dollars in offering proceeds. And they're able to achieve that however they're able to achieve that, or on other platforms or TikTok or whatever it might be. And then once they figure that out, they obviously pour a lot of the marketing budget into those strategies because they're converting well. Whereas others are, they're launching 4 or 5 different marketing and promotional strategies in the beginning, and they're, 4 out of 5 might not be working so well. So you have to kind of rejigger and figure out what is. So it's a process if you're relying solely on digital marketing. It works for some, but my advice is be prepared for it to be more expensive and to take longer than you might expect.
Do you have any specific examples you were willing to share that you've worked with?
I'm careful about mentioning too many issuers' names because I don't want to give the appearance that I'm referring them. But on our website, we list many of our live offerings. The Reg A, a number of, not all of them, but a number of them. We list the offerings. We also list the fractional share platforms I was talking about before.
You believe in yield to raise money? It's more simple for the average investor to understand. If so, how high to capture interest?
We have, yield is vanilla, but vanilla could be sexy, especially in a low interest rate environment, which we had, and hopefully continue to. We'll see. But, yes, giving the average American the opportunity to participate in a REIT for a few $100, right, easily on their iPhone, present or an energy contract stream or whatever, or rental revenue. I think that is super attractive. I do, and we're seeing a growing number of yield issuing entities that are using Reg A to conduct their offerings, right? Because our transactional fee for a lot of these clients is down to 1%, right? So generally, if you're issuing yield, you're super sensitive to fees. So you got to keep the payment rail cost down too, right? You got to keep the credit card. You may not encourage credit cards to be used because then you're paying the credit card processing fee. You may be more oriented towards wire or ACH and a broker dealer that has a really low cost structure, and that can make sense for a yield issuer. But we have a growing number of REITs, of yield-based offerings, and some are doing quite well.
So what is the best way? Is it bonds?
Bonds is one way, a flow through of revenue, or on a yield basis, multiple structures. I don't know if there's one best way.
Next question is, what is the role of a broker dealer here?
A broker dealer gives an issuer the ability to conduct their offering through a regulated entity in order to sell securities in all 50 states legally, right? Provided the broker dealer is licensed in all 50 states. For Reg CF, you need to work with either a registered CF portal or a broker dealer. For Reg A, you don't. You could issue direct without the involvement of a broker dealer for a Reg A. The problem is there's a number of states, including Florida, Texas, New Jersey, and some others, that many issuers find it challenging in order to conduct business there because you have to do additional registrations. And as a result, many of them find it more cost-effective and efficient to hire a broker dealer that is licensed in all 50 states that gives them the ability to offer their securities in all 50 states. So the broker dealer role includes upfront due diligence, right? We're doing bad actor checks on the officers and directors in the issuing entity, ongoing diligence, review of all the materials, review of the marketing and promotional materials, and ultimately the review and approval of every investor, right? From a KYC and an AML and a suitability and an OFAC perspective, making sure people are in the right jurisdictions versus not, and reviewing and approving all of the investors.
Right. For Akamoto that went public via Reg A+, they had a bunch of blowback from the public market folks who did not process that they were still an early stage startup. What kind of blowback do you see when companies use Reg A+ and hence are required to register with the SEC?
I don't see a lot of blowback in that regard personally. So I don't have much of a comment to that.
Okay. You talked about the cost for Reg A and Reg CF, but not for Reg D. what would you say about the transaction fee for Reg D?
Expect there to be a upfront due diligence and onboarding cost, right? And then a similar type commission structure for, as you'll find with Reg A typically, I would say. That's for providing the kind of the baseline broker-dealer services. If the broker-dealer is raising capital for the offering, that's a whole nother story. Then there's success fees that go up to 7%, 5, 6, 7%, depending on the size of the offering.
Right. And what are the top mistakes to avoid in a Reg CF or Reg A plus?
Don't assume that if you build it, they'll come. Don't assume that if you list on a marketplace or with us, that you don't have to continue to be involved and creative. And make sure that you work with the right counsel. It's so important. It really is. You know, experienced counsel that has experience with, if you're going to do a Reg A with going through the SEC process. Make sure you're working with a broker dealer that does this, that specializes in this, because you know you need to have that stable ship before you sail, and also try to understand how you're going to win before you make a decision to do this. I know that you know there's a lot that it's a nuanced kind of approach, but it's so important that you understand how the different tools that are available to you to try to succeed. And again, those include digital marketing, PR. They include the inclusion of influencer networks, celebrities occasionally. They include financial publications and newsletters, and they include sometimes investment banking assistance, right? Traditional investment banking, as well as co-listing and syndication, right? So there's a lot of, I just mentioned like 7 or 8 different tools, but you know, we've been around since 2005. Our roots are in investment banking, and we look at ourselves as partners with our issuers. So we want to try to use all of those tools, if we can.
And how optimistic are you with the secondary market in Reg A?
Secondary market's great. It gives investors an opportunity for a path to potential liquidity, meaning there needs to be a bid there, right? And that's unique because otherwise you're waiting for a liquidity event. You're waiting for an IPO, you're waiting for another round or a distribution, and those things could take years. So having a mechanism in place where there's an out, provided that there's someone that's willing to buy your shares, is profound. And I think but it depends how it's used, right? So as of now, where we're seeing most of our, because we provide secondary market trading services as well in partnership with a number of different ATSs. So right now we're seeing most of our secondary trading activity in the fractional share kind of collectible space, real estate space, right? These are companies, again, that are launching those individual assets and fractionalizing them into like $10 or $50 shares, and then including on their app the opportunity to buy the IPO of that asset, and then right next to it, the bid and ask column for secondary market trading, right? So that works really well when you're buying like a sports card, right? You're investing in a Michael Jordan rookie, like I mentioned before. You're buying a $10 share and it's a $100,000 valuation at the time. You want to be able to buy more, or you want to be able to sell that at a later time. So it's great to be able to have that secondary marketplace in that ecosystem available for you to be able to see price discovery and also kind of see what it's worth and gives you a potential path to liquidity.
Next question is, do you see any specific industries more than others using Reg CF versus Reg D?
No, not at all.
Okay.
You know, there's no reason not to for whatever industry you're in. I don't think it really makes it. It's more about how much you're looking to raise and from whom you are looking to raise that capital from.
So the next question is, what investment banks are active in the A+ space aside from yours?
I think I'm just kidding. I was going to say just us. No, there's investment banks. There's a number of them. You know, I don't know how many offerings they're doing and kind of what their approach is. Reg A is kind of very different. It doesn't have to be very different, but it is very different than Reg D. Reg D, investment banks would take on an opportunity, and as an engagement, you would pay them the upfront fee and the 7% commission on success, or maybe monthly fees too. And with the idea being that they would go and they would approach their network of retail investors and institutions to try to, facilitate some interest in your offering. It would lead to a meeting. It would lead to hopefully a term sheet and a negotiation, and hopefully a structure that would work for the founder. Good luck. It's not an easy path. And it's certainly not an easy path for minorities or women, unfortunately, right? And so what Reg A has done is it really levels the playing field. I'm taking my offering, I'm taking my structure and terms, and I'm presenting it to the masses. And anyone over 18 pretty much could invest in that, right? So it's quite powerful.
Any emerging paths of secondary trading? You talked a little bit about that before, but anything to add to that?
Yeah, I mean, you're seeing companies that tokenize their shares in their offering that are more on the digital side, that typically would include secondary market trading for those tokens. You see the collectibles industry that's very active on the secondary side. Really, it's the fractional share issuers that build a community of investors that have an interest in building portfolios of their assets. Those are the ones that we're seeing quite active on the secondary marketplace. Whereas if you're a one and done type of an issuer, you're looking to raise $10 million and then you're out to whatever's next. The founders aren't typically thinking about they don't want to pay an annual listing fee to get their, to have access to secondary. Maybe their investors aren't, itching to buy more or sell. Perhaps they're thinking about a potential exit or a going public event. It's a very different dynamic of investor that's building a portfolio of assets because they want to trade that portfolio, right? And they're going back to this app, and the community on that app is building. So there's a greater audience building for secondary that could add to that bid or ask over time.
Should we list in NASDAQ, for example? Is it worth it, if only for marketing purposes? What's the role of NASDAQ going forward?
Yeah, why not? Yeah, I mean, it's the dream of many of our issuers is to list on NASDAQ. You get a lot more exposure. You get another even greater path to potential liquidity. It's not just a matter of I want to list on NASDAQ. There's a bunch of steps involved before you could qualify, and a lot of expenses involved. But yeah, I mean, I think that's a great plan, and I wish you the best of luck. Right.
And do you have any resources on tokenizing shares?
Absolutely. It's more and more a topic of discussion these days. We've all experienced the growth of the digital NFT marketplace, right? In 2019, I believe there was $95 million of NFTs that were issued and sold. And it grew rapidly to 2021, where there was over 25 billion sold, right? And there's also looming regulatory enforcement that's going on right now with companies that are fractionalizing and issuing shares in NFTs or digital assets, and fractionalizing them, IPOing them, and facilitating secondary market trading of them. If you're doing that in the US, my advice is to do so through a registered broker-dealer. I believe that those are securities, and not just me. I think that a lot of the thought leadership in the space and amongst the law firms are guiding their clients accordingly.
So what do annual listing fees look like for Reg A?
Annual listing fees would apply to if you wanted to be listed for secondary market trading. Okay. On the primary side, there are no annual listing fees. And the annual listing fees range from, it's quite a range, but from as low as $10,000 to as high as a few $100,000 a year, depending on which platform you work with and what type of deal you're able to negotiate.
Okay. A convo here. As a company that has raised a CF, the audit reporting is not a significant cost. We also consider TSX. Question, what is not significant number? 50K a year? Answer, for us, 15K right now, 1K for the ongoing recurring reporting, but we've automated drastically and focused on building a clean company. What's your take on these fees that they're talking about for CF? You think they're going to stay that way, or do you think they're going to rise up?
For audits?
Audits, yeah, and reporting.
Well, right. So as far as audits, it's CF or A or any audit, right? So if you are setting up a new co to act as the issuing entity, which is fine to do, then it's a few grand. It's not a huge expense because there's nothing really to audit, right? Just a few transactions or maybe one. Whereas if you're a company that's been in business for a while, and you have a number of different divisions, or you have an extensive number of transactions, it's going to go up from there to 10 or 15 or more. So it really depends on your books, your records, your statements, and which company you're using to audit your financials. I mean, we have relationships with many different auditing and accounting firms that are pretty efficient and cost effective if issuers need.
Great. I'll give the audience just 1 or 2 more moments for any final burning questions. We will connect everyone here with Etan to follow up with more specific questions and what they do with Reg A, Reg C, Reg DF. Etan, any final closing words from your side?
Final closing words. I will reiterate, well, first of all, there are 27 million or so private companies, businesses in the US. My belief is that most of them don't even know what Reg A and Reg CF is. And I mean, we're so in the weeds with it that we speak about it every day, but most companies don't necessarily know. And if you look at how much money is being raised in both through both of these exemptions, you'll see very significant growth right through the pandemic. And I believe it's indicative of how both of these exemptions, President Obama in 2012's Jobs Act, really was designed to, I think, democratize access to investment opportunities so that anyone over 18, accredited or not yet accredited, now is given the opportunity to invest in what they believe resonates to them or what they believe might become the next big thing, right? There's obviously risk to it. Historically, most companies fail. But now everyday investors are empowered to kind of become their own venture capital investors. And so the idea is probably to diversify and to do your diligence. You know, I think that this market is going to continue to grow at these rates and beyond. And we're certainly grateful at Dalmore to really feel like we're at the middle of this. We got involved very early. And what we provide is a path for companies who want to host their offering on their own domain. Certainly companies that have a large network of fans, followers, subscribers, or good PR, or are super relevant to what's going on in this environment, that's a really strong consideration. And that's what we specialize in. We have a network of marketing companies, of law firms, of transfer agents that we have available to our issuers. And I would just end with reiterating that this is not a you build it and they come type of proposition. You need to go into this level-headed. You have to know exactly what your risk is and what the costs are, and what it takes to succeed, and the tools that are available to you to succeed. And that's really what Dalmore is really focused on. It's what's working, what's not, and why, and how do we learn from that and share that knowledge and experience with new issuers.
Great. 2 final questions. Can we reach Chinese investors?
I don't think so.
I think it has to be U.S.
No, it doesn't have to be U.S. investors. It could be, you could raise, international investors could invest in Reg CF and Reg A offerings, but there are certain jurisdictions that you stay out from. You know, Iran, Iraq, probably China, Russia, right, these days, and Canada, interestingly. But other than that, many of our offerings have a significant base of international investors.
Okay, great. And how will CF and A impact the angel VC path?
People like to say that it's like a battle between, right? It's not. They're both going to continue to exist, and they're both going to work in harmony. In fact, we have a few VC private equity firms that have been running their portfolio companies through the Reg A process, one after the other. Mm-hmm. So it's a tool that the VCs are using themselves. You get to build investors, you get to build a bigger audience, you get to market the offering, you get to figure out the secret sauce of how to convert and how to market and promote on one of your offerings, and you could apply it to all the others. So I think that's where it's going. I think it's working in harmony. I think one of the, back in the early days, the concern was how is the venture capital community or future rounds, institutional rounds, going to look at me if I raised money on a credit card from a non-accredited investor, right? Will that taint me, right? Is that and I think that was a concern we saw years ago. I think it's changed today. I think what it shows institutional investors, if you run an offering and you're somewhat successful in it, is that hundreds or thousands of people bought into my message, and they made an investment decision, and they're probably loyal followers and customers going forward. So I think that's an advantage, and it also helps you meet potential listing requirements if you are considering going to NASDAQ, right? You have a larger shareholder base.
Great. Final question is, will we get a copy of the chat? Yes, we'll include that with the follow-up mailer to everybody who came today. The chat had a lot of great information in it with questions and resource information. Etan, thank you for joining us today. Appreciate all the great information. I'm sure this was quite a challenge to go through all these questions in such a short amount of time, but appreciate your doing that. Audience gives many kudos and thank yous for that as well. Appreciate it. We'll connect you with these guys as well. And we'll want to go ahead and close it up now. Thank the audience for asking great questions and being a great audience and coming in and making this a very interactive and lively discussion. And with that, we'll go ahead and close it down. Thanks so much, Etan.
Thanks all.
Thanks guys for coming.